Thank you very much, and thank you very much for turning up. The general overview, oh, that sounds quite loud, sorry. The general overview of what I'm going to be talking about is broadly an introduction to economic knowledge and knowledge more widely. And then I'm going to apply it to a particular time series that we're all rather familiar with, which is GDP. Then finally try and put the two together and discuss things a little bit based upon that. I've chosen a lot of the talks I've sort of seen on YouTube seem to relate to topics that really aren't discussed. I'm sort of doing like a wolf in sheep's clothing type of topic today because I feel that basically I'm presenting almost a neoclassical viewpoint, but trying to actually articulate what goes on behind the scenes, because I think it's something that's important that isn't actually discussed that much. So I'm trying to go into what is the basis of knowledge in relationship between theory and data in current economic thinking broadly, and then applying it to a very well-known, quite badly articulated data series, and then hopefully from that drawing a few conclusions that we can then use as researchers ourselves going forward. So I start with the most important slide, which is, as it says there, here is a blank slide. Now, what I wanted to put that up was to try and express the concept of what do we actually want to put up here? What do we want to constitute? What do we actually want to put up there that constitutes economic, and what is our economic knowledge, and what's our threshold for actually saying this is something that we need to talk about? And I'm really trying to push us all to think about the notion of what is actually knowledge, what is truth. And so I hope that the more active among you, though it is lunchtime, so I do bear that in mind, have already drawn attention to the fact that there's a lie on this slide. This isn't a blank slide because the statement, here is a blank slide, is on there. So that's the type of discussion I'm hoping to have today, that we really need to consider what is the threshold for saying we do actually want to consider this as knowledge. So in very, very, very brief terms, I've flagged up a few points of interest for me personally in relation to empiricism. The first one is Hume's fork, and with that basically Hume articulated that there is a division between the ideas space and reality, and we need to bear that in mind when we're talking about different bases of knowledge. And if you almost want to think about it, you could have, say, in the ideas space, you could have an economic model that's been derived through axioms and is logically consistent within that space, and then you've got the reality of how much people are actually buying. So that was the first one I wanted to flag up. It then linked into a movement that was sort of more towards the 20th century about empirical positivism. And that basically was the idea that you can't prove the things in that model space really until you start to dip into this reality space. The third person on the list, Karl Popper, basically turned around and said, well, that's a bit hard to do because, you know, the threshold for proving something as truth is really quite hard. So he turned around and then argued for much more of a position of falsification. So you make a statement and then you're trying to find the burden of evidence that disproves it, and then kind of what's left over is sort of the conscious body of what we understand in the economic community. I suppose if you want to think of an example, the classic philosophy one that people will use is all swans are white, which is all swans are perceived to be white until you arrive at the point that there is a black swan, at which point the phrase all swans are white is then disproven. So we now understand that you also have black swans when we discovered Australia. So these are very brief introductory concepts, and I'd encourage you to go and have a look at these in more detail. I've got some links at the end for the Stanford Encyclopedia of Philosophy, which goes into great richness. But it's also worthwhile saying that these are contested notions. Empiricism is not, in and of itself, well, like all philosophy, it's very well debated. So on there you'll find the nature of the discussion, but the representation here is to say that this is broadly the framework in which we are using data in economics. That's the scientific one, but there is also then the empirical sphere, and I've sort of then dipped back a little bit further in the timeline to sort of briefly discuss here the nature of Jevons and Mill And what Mill said is that broadly you have a multiple chain of events that can basically result in social phenomena. You can't create an experiment. Whereas Jevons was then trying to come up with different ways of trying to solve that. So he acknowledges the difficulties that having multiple sources for different events in society can have. Then, sorry, it's easy for me to read from here. Then said that actually there's a very strong relationship between the nature of the theory and the nature of the measurement, and there's sort of like a sociological process if you think about it. The more you observe, the more you can then start to theorize, and back again in terms of how you then capture the data. And for him, Jevons articulated a view where we go towards trying to understand one single cause or one primary cause in explaining different elements of causation. And so I've found this, which is our beloved friend Milton Friedman, who basically summarizes those different strands of philosophy, saying that, in short, we need to work out when we use data, is something right or is it wrong? And ultimately that we are using this to then to basically populate that slide from earlier. So we then create this body of knowledge. And if you notice by the end, he's then also getting into this falsification territory, saying we can't actually prove a hypothesis, but we can disprove bad ones. So that really was a summary whirlwind tour of philosophy. I'd strongly recommend, like I say, having a look at the Stanford Encyclopedia of Philosophy, because it will go into a much richer level of discussion on that. But for the purposes of the discussion that I was wanting, that arrives at basically what I've put up there as premise one, which is that economic knowledge is conditional, which is that even if you adopt the falsification rubric, you're still falsifying what we consider theories on the basis that this is what the data says. So to be able to arrive at the position that something is false, you're relying on a true stream of data coming in. So that's the key element I wanted to have coming out of that. A pretty picture I found to articulate this sort of relationship between theory and data comes from this book on econometrics and philosophy of economics, which looks at the relationship on the left-hand side in relation to how we actually arrive at the theories, which, as we all know, you often do a model, do some simplifications, and then you arrive at particular empirical observation or particular hypotheses, and you can then start to articulate them by then testing against all of your data. Now, you've got, at the top left, you've got sort of a conceptual universe, so you have different theories that operate. So it might be something like, say, a solo swan model. You've derived it, that's where your solo swan model is. But then what I want to talk about today is all of this right-hand side, which is about how do we arrive at this position of data series? How do we get to that type of area? So in short, there are three sort of areas I'm going to be sort of broadly talking about. One is the practicalities of collection, so actually going from that idea of the sample population to actually then arriving at the information in your observations. There are also aspects in relation to data theory, so what are these concepts, where do they come from? And the other one is sort of the validation rituals, which is how we actually feel comfortable about the data that we're using. So the second step of the presentation is then, this. Now I've put a little note up there saying that for the purposes of discussion, I'm not entering into the territory of things like, is GDP a means or as an end, or any of those types of things. I'm not entering into normative discussion. I'm just using GDP here as an example of a data series that you could use. And the same would apply for if you're going to say labour statistics or anything else, just to try and put in all of our heads, what are we actually thinking about when we're looking at these data series? And I'm doing GDP because it's an area relatively familiar to me for my work. So this, in terms of where does it come from, this is a very, very, very early form of income estimation. It came from Richard Stone's lecture when he gave the Nobel Prize, but it comes from the 1700s when people decided to start to want to measure the economy. And you see on there you've got different sectors that are being included. I think one of the beautiful things when you start to go back to the early estimates of how income is estimated in the economy is you can tell an awful lot about the nature of how that economy works. So in here you've got land, estates, and labour. So it's a very different type of economy at the time to where we move forward. And there's an element of something important in there because all of these measures are a reflection of the times that we're observing them in. So that's something to always bear in mind. I put this up there to show that there's been a long history of trying to estimate income. And in this particular example, it shows you that there are elements of control, there are elements of ownership in there too, and a structure of a very old-fashioned economy. But really, there are multiple different terms that have been used to describe it over time. You've got from income measurement, product, national dividend measurement, political arithmetic. Everyone basically trying to do the Adam Smith thing of how do we arrive at wealth. And the particular measurement GDP comes from a time in the 1930s when there was basically a step change in the way we measured things. It was published in the 1940s when we went to war, and it was very much a reflection of how the economy was forming at the time, and the main concern was trying not to end up with inflation. So the better idea we have about how the economy is performing, then when we look at the dividends and distribution towards different people in society, we can then work out, is there going to be an inflationary feedback? Is ultimately our war engine going to be suffering because of that? Now, that came from a lot of research that came in the 1930s, which seems very much to have been strongly influenced by the effects of the Great Depression. It triggered a lot of business cycle research in America. That then came over to the UK and in various parts of Europe, where people started to go, well, but how does society operate? Until this point, there was a very laissez-faire attitude. If you have a look at the data that was available nationally, you'd find that there were basically 5 national data sources, which were like total level of employment. There were some international trade figures, but there was no effort at all to actually bring it together to understand what is this big picture. And so the 1930s sees this moment where all these events are impacting on people, and researchers and government turns around and says, actually, you know what? We need to understand what are the impacts, what the spillover effects of me upon you, of me going and buying something, what's the impact of you on somebody else. So that's where we end up with the multiplier coming from, and it's also when we see the emergence of what was then called social accounting. And the name pretty much implies it all. It's trying to account for that social relationship. So that lasted. The government then in the 1940s then ramped up their measurement approach, and then by the end of the war, this is when the ideas then started to get codified and turned into forms of practice. And so from that moment of inspiration saying what is out there, we then go, and now we have a standardized process. And this is when the United Nations comes up with its system of national accounts, and this is when a largely Anglo-Saxon approach towards national income counting emerged. There were revisions every sort of few decades afterwards, and different forms of thought were brought in. So there's a Scandinavian amount of research that was looking at particularly the separation between the financial sector and the real economy. There were revisions to bring in input-output tables, and basically it's where we are now is a cumulative effect of revisions that have happened mainly by bureaucratic bodies with some academic involvement at the early stages, but we now have statisticians looking into these areas and statisticians finalising and updating the way we perceive the economy. So then what actually is it? I think what you typically hear in standard lecture is that, you know, there are different ways of approaching it. You have your income approach, you have your expenditure approach, you have your production approach. and broadly you have the data that comes in. You can then verify the different data sources against each different approach, and then on the basis of that you can then arrive at this overall figure for income. But I think that and this is sort of the bulk of what I want to talk about, is we need to understand the processes that go into it as well. So the main output is the ONS Blue Book. There are so many subsectors to that, which is a fantastic, rich source of data for a whole load of analysis on different subsectors of consumption, down to what baskets of goods are being consumed, what type of investment is being done in what type of organizations, what type of capital expenditure is going on. And I was tempted to put up some of the slides from the ONS on that, but there would just be too many because the detail is so rich that actually I think it's something that everyone should go do at some point. But the key thing as well is to have a look at the notes that accompany it, because actually there's an awful lot of subjectivity that feeds into this figure of GDP. The question is, how do you arrive at 1 million GDP? What is that? And to arrive at that, you have a series of different complex interrelationships between the economy. And so one of the forms of there's debits and credits. This is a mechanism that was particularly put in the 1940s to see the interrelationship between the different sectors. So you have not just in terms of the C plus I plus G plus X minus M rubric, it's much more in terms of how is industry relating to the household sector? How is that then relating to government? How does, if one is spending more, what happens to that flow of money? And actually, as soon as you start to look at that, you can then end up with some interesting narratives emerging. And there's a New York Times article a few years back saying that it was that type of analysis done by somebody here called Wynne Godley, that looking at flow of funds at a very high level, that you were able to predict many of the mechanisms that kicked in for the global financial crisis. Because fundamentally in a closed system, if money is going from here to here, then you are able to understand a lot more about both what's happening here and here. So what I mean by that is, if you have a high level of consumption going up, you then need to have a look at then what's happening to the other sectors. When you then have a look at the other sectors, you can then see, where is this consumption being funded from? Is it indebtedness? Is it from incomes? If it's incomes, where's that coming from? And you can end up with such a level of richness from that, that I genuinely think that the Blue Book is something that should be visited by everyone at some point. The way in which it's structured is around, nowadays, is around an international accounting standards framework. And the main objective of that is so that you can get some form of comparability across different countries. That's comparability in the sense of conceptual comparability, but the reality on the ground can often be quite different. So there was a talk a few years back here with Angus Deaton, where he was saying that actually the nature of a t-shirt in one country could be very different to the nature of a t-shirt in another country. Because a t-shirt could be a very, if it's particular, let's say it's an American import good, well, relatively cheap in the UK, so there's a different cultural relationship to that, to say another country that might have relatively lower income, where it might be very much a higher brand, higher end good. So actually, when you get down to that level of detail, which is what the GDP does, because it summates everything, actually understanding whether things have been categorized into the right areas is a very important thing that you need to do when going and having a look at the data. Finally, yes, an important thing that I think can't really be missed is in relationship to how this is published, which is, I just took these from the ONS guides, and it basically outlines the different level of information that is used to arrive at each one of their outputs. And sort of, for my mind at least, helps to explain how you often hear in the news that, oh, we did better, we were going to have a double-dip recession, no, we weren't going to have a double-dip recession. And it sort of shows the pressures that actually the stats organizations in what can be considered a very well-resourced country are actually being influenced by a need to quickly turn around information. Now, the thing is that is, I think the figures showing what actual data is used. Now, by actual data, what they mean is this is where they've gone out, they've got some surveys, they've verified the information, they can come back and say, we think with certainty, or near enough certainty, that this is what's going on. You would potentially think there are bigger swings, but actually it turns out to be something like 0.08% change in GDP, nominal GDP, overall over the whole process of all the different revisions that go on, which I think is an indicator of the strength of the process to a degree. But then we come back to that, the red line on that diagram earlier saying theory, which is there are issues sometimes with the concepts that underlie it. So these are well known. I've taken these from Richard Stone's Nobel Prize lecture, where he got his prize for social accounting, and he turned around and said, these are the biggest barriers that we face, and they've been barriers that have been around since the start of the movement. So what is the classic example in the past of formal versus informal used to be, imagine you are working, imagine you decide to marry your cleaner. Then all of a sudden you've had someone going from the formal sector to now the informal sector, because now your wife will be doing your work for you. So the tone of the formal versus informal debate has changed a lot now. But it still remains the question of where do you place the boundary as to what you're counting as actual economic activity. If somebody's going along and selling a few goods on the sly to someone, should that count towards your GDP? The other one is the activities of government. More often than not, you can estimate something like the amount of, let's say, schooling. You can estimate the costs that go into schooling, but if you think about when you go to the shops, you're not buying on a cost price basis. You're buying on the basis of, well, whatever extra profit they're getting in there, and on a variety of different branding, things like that. So there's an element of return kind of featuring in there. So how do you actually account for what is education? Do we have to come up with a figure for what the estimated return is on individual students and then incorporate that into the accounts? What seems to happen more often than not is people use a proxy for the private sector and bring that in. But it's still the case of even if you do that, you don't have a notion of, say, universalism. What is the benefit of, say, a universal coverage of education? And that's something that isn't then being brought into that measurement. Another one he gave us then, basically the allocation of time. If you get something like a durable good, let's say you buy a fridge, you're going to be using that over the lifetime of the fridge. In reality, if you're trying to measure economic activity, there is still economic activity going on along that time period over many years. So there are questions of whether you should be attributing the consumption over that time period or do you not, type of thing. That's a bit of a misnomer example, but it gives a concept. And then I'll just skip to the pricing of investments in stocks. You need to just turn on to the BBC at the moment and just see how much they vary on a day-to-day basis, and then trying to work out whether that is actually a good way to understand how investment is working in a economy. So again, this is purely just in terms of GDP as measurement, not GDP normative, is it good or is it bad? But these are just some of the barriers on a conceptual level to what is the economy doing? Is it working? Now, these are ones I've chosen for the UK, but then I think there was a talk by Morgan Yervin a few weeks back with his Poor Numbers book around Cambridge, and these are some of the main issues that he noted when he was looking at sub-Saharan Africa. At the very top there was staffing, and he found in his research that in some cases some of the national statistics agencies will have maybe 2 members of staff, and this can be for an entire country. So the reality is that you can end up with people just having to come up with assumption after assumption after assumption after assumption. And one of the big problems that features in there is circular estimates as a result of that, which is that you could end up with, I can't remember offhand which country it was now, but they're using agricultural productivity figures which were feeding into GDP. The agricultural productivity figures were reliant on population figures, but because the population surveys were being done maybe once every 20 years or so, actually the population figures in the spreadsheet were feeding back into the agricultural figures, because the argument was that agriculture will increase. With agricultural increase, you'll have increased population because people are able to have more children. And so basically you end up with a completely circular logic where agriculture appeared to be being derived on the basis of a random arbitrary increase in agriculture, which was something like 2% each year. So it meant that for a sector that was a major sector in that economy, it was completely misleading. Other examples that he gives in there are the inconsistency across different data series. So he gives the example of the Penn World Tables, the Madison data tables, often national figures and world development estimates. And it's not so much of a problem for the larger economies, but certainly when you get to the lower end of the table, so if you're doing any form of cross-sectional analysis across countries in sub-Saharan Africa, for example, or if you're going to be doing time series, the reality is choosing your data set will vary where your country is. And it's something that is highlighted in a lot of lectures, but the reality of that is that we don't know how those economies are actually doing. And that is a bit scary when you then start to make any sort of causal analysis from an economics perspective, saying, actually, this is how the world is operating, because your perspective is just being completely biased by whichever form you're taking. The other point I've got on there is different schemes and operations. So I mentioned earlier about the different revisions of GDP. Each time we end up with major different conceptual perspectives. So the most recent one heavily incorporated the informal sector, which as a researcher you might go along to a data series and go, oh great, so this is going to have the informal sector. So you then start to build that into your analysis and your intuition when you start to look at it. But again, Yervin went and had a look, interviewed the people on the ground and found out that no, in some cases, some countries are using still the 1950s approach to estimation of GDP. Some were using much later. And so again, any idea of using cross-sectional analysis, you can have major problems there. And I think that the summary that I would take away from this and his book, which is brilliant, is that there are many systematic biases that feature in our estimates of particularly poorer countries. And I think that with all the mix, it sort of comes back to this question, how big is a country? And this is just a fascinating example that happened recently with Nigeria, where there was a complete revision to how the country was estimated. So all of a sudden it was 83% bigger. So much bigger it overtook South Africa, and we went from being in BRICS territory to mint, and it's the N in mint, I believe. So it's such a big revision that all of a sudden from what people would be worried in some level, we now into the territory of going, oh, but there is value there. And it's not just the oil sector that fed into that. There's aspects of their production and other estimates of the informal sector feeding in there. But it can also be quite misleading when you then start to have a look at these figures, because you then start to say, oh, well, the country's rich enough, therefore it is less of a concern. But actually, I think it's 1.83 million, was it? No, it's 170 million people living on less than $125 a day. So that the numbers on a psychological level can also be very misleading. So I've given some sort of more developing countries, and it turns out a very well-developed country within the last couple of years that grew very developed overnight, to the UK. And I just want to flag up the most recent revision to incorporate the informal sector. As you see here, there's some major revisions to GDP occurring there. And it was particularly sexy at the time because 0.7% increase to GDP in the UK attributable to prostitution and drugs, because they're very big sectors and we hadn't measured them before. But there's a very large element of estimation there, and it's very questionable whether those figures are actually holding there. But I think that the point to bear in mind coming out of this, and also with the point about different countries with different levels of standards, is bearing in mind the revision process, which is that you may have a concept which you're using to go out and measure, and in this case we've now incorporated the informal sector, so we've changed the boundary of production to use it. Well, what we're now doing is we're using this, and knowing how the ONS works, if you go back maybe probably to about the 1980s, there will be a revision of the data back to the 1980s. But given staffing levels and resources and pressures to produce other statistics, what you'll find is that you'll find older versions of the SNA, the System of National Accounts, being implemented in the earlier part of the time series. So possibly, I didn't have the time to check, but I'd be willing to reckon that from the 1980s to the 1950s, if you were to get that data series from the ONS, it's probably operating on a much earlier form of national accounting standards. So in effect, you've got two different data series when you click that button to download, and that's in the UK, which is why, as I say, you need to have a look at that information in relation to the Blue Book and looking at those detailed notes at the front to find out actually what are the rules that are in place for this data and how long does it go back for. And I've put in the bottom there about the notion as well of there's, with a lot of numbers, when we see a number on the page, it fills us with a lot of certainty and we start to believe it very strongly. But actually, and there are lots of social anthropological studies that show that in the run-up to the production of that information, there's a lot of subjectivity, there's a lot of judgment. As I mentioned earlier in relation to stock prices, we'll probably go at one particular time period, but there may be, let's say, a transaction happened before or after the time period. Should that be included? Should it not be included? And we have all these questions about the data until it goes through sort of a verification ritual and we say it is now published. And at that point, we then suddenly place a lot of certainty on something that still, till that point, is a concept and is actually uncertain. So this is where it's really important, as all of us as researchers, to actually go away and actually think in advance and do detailed research on that. There we go. Oh, sorry. So why should we care? And this is where I draw back in premise one. Premise one was articulating earlier that truth in economics, that what we use to fill that blank page, is conditional on data series. And as soon as you start to have any concerns about how it's actually being implemented or any elements of your data series, then that means that the knowledge that you have based upon that is also in doubt. So that's why I think that both of those things need to be considered together and need to be articulated more strongly in lectures, because it puts the burden back on us as researchers. In the past, for example, I mean, I've used GDP earlier, you used to have a unit in a lot of different universities on social accounting. So you would actually be able to create the accounts yourself, be able to understand the interrelationships between different sectors. Whereas nowadays, what you'll find at best is you'll have one project, maybe in second year, maybe in third year, I don't know, but you'll have the odd project here and there where you're told to go away to look at this data series. And there was an interview once with Evan Davis, the now reader for BBC, that he went along and tried to get the figure for consumption from the ONS website, and he struggled. He really struggled, and this is a trained economist, and he was struggling to get the figure for consumption. There are terms that we are taught in theory that are staple things, and we struggle when we actually come around to using them. So I think that that's a very important lesson that I've sort of wanted to express in this lecture, because there is a backstory to data. There is a backstory to how that figure arrives in front of you. And if you don't get it, you can potentially end up saying falsehoods. And the examples up there are the ones that Yervin gives, where he says that if you have a look at some countries in relation to doing analysis to see did structural adjustment help or hinder the country, actually, in some countries you can't tell, because it literally comes down to the data set you use. One data set will say that structural adjustment program was great. Another one will say moderate effect. Another one will say a negative effect. And when you have that level of uncertainty surrounding it, then this creates, we should be challenging the empirical facts that are being presented. And it's a bit of a misnomer as well, putting Rogoff and Reinhardt on there, because I appreciate they weren't doing the earlier stage that I've been sort of talking to, which is the data collection. But I thought it also brought home the policy element, which is that numbers, ideas do have an impact on the policy environment, and with their particular, this time is different, data set, they helped set the framework that many people used in the time of the global financial crisis to argue that we should be reducing the amount of debt in government, because their data series that they've been, well, there were problems within their Excel spreadsheet that a researcher in America was able to find, basically created the result that you need low debt to be able to grow. And so that phrased the austerity language which we now live in today. It's also important for, on a wider sense, in terms of the feedback in terms of government, because it's, for example, GDP and other measures are used as principal forecasting tools. So we really need to critically think about what are the ideas we're using when we start to observe data, how is it collected, and then how are we then using it as researchers. And as I've put down there, one of the biggest problems as well is then we end up with any combination of data series. Combine GDP per capita, so all the questions about GDP, add in per capita, and just bear in mind that population can be a horrendously political activity, going along and getting an estimate because you're recognizing groups, and often groups want resources. So in certain countries, you'll find that there are issues with population estimation. A compound figure like GDP per capita has so many biases featuring in it that it is questionable when we use it, whether we are actually understanding that and actually using that to inform our policy evaluations as we move forward. So I gave GDP as one example, and the reality is you could do it for any of so many different data series. Unemployment is the classic one where if you speak to many of the lecturers here particularly, they'll say that under Thatcher, unemployment was revised something like 18 times. The definition was revised 18 times. That means if you get an unemployment data series, you really need to do a lot of work to make sure that it actually contains one consistent definition, whether you agree with the definition or not, just on the basis of getting a consistent data series. Otherwise, you will have systematic bias. Now, I sort of raised the Evan Davis question, but it's sort of a question I hope that you're thinking about, which is, if I was asked to go and look at a project, if I was asked to go and do some economic analysis, what would I do? And I think that that's the key thing to take away from this, is that we should be asking that question. Because as soon as you have that question, as soon as you have the skepticism and the uncertainty, that's when you then do more checks to actually reduce the number of times you're coming up with those wrong answers, and actually whether it's cleaning the data, whether it's understanding the data, but spending time to critically engage to create that data series is one of the most important activities you could do on an econometrics project before you even click a button. So that's a very important thing. Now, you're probably wondering who this guy on the right-hand side is. I've mentioned him a few times. He's Richard Stone. He has a fantastic array of bow ties, and I'm very jealous of him for that. But I put him up because I wanted to sort of hark back to the 1930s and that moment where we started to measure the national economy. Because at that moment in time, I said there were a few data sources, and yet these people went away, they sat, they thought, and they came up with new concepts and new ways of structuring the economy so that you could end up with a useful tool. And how did they do it? They just went away and they became familiar with the information. Richard Stone produced a data output called Trends, which just collected and analysed information from business. And from that, he got the experience as a researcher to then go away and actually be competent at dealing with figures. It was the actual engagement to develop those skills and get that experience that meant that he was then able to enter those new territories. So I was sort of wanting to flag that up to you in the room and hopefully the members on YouTube, to say that actually you should be thinking about what you do. When was the last time you had to look at a data series? I'll hold my hands up and say it's been a very long while, and I haven't done that much work recently on data series. But if I was about to do some data series work, I'd want to make sure I'd at least practiced a little bit first, because otherwise the big danger is you'll graduate from a degree and you'll just go straight into an organisation where you're then told to get the GDP figures. You get the GDP figures, you then turn it into a quick statistic that then says, oh, this is what your potential profit could be in the country. Done, 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 next question. And actually, that's the whole point. What is on that blank page? In that situation, to be frank, the page should be left blank. And so I finish with this, which is Greek, and I just need to check the translation again, which is know thyself, which is, I've put it up as a warning to make sure that we're actually all aware of our own skills and our own experiences before we go and do research, to make sure we are being humble with the data and we understand that actually what data is a construct. It's more from the abstract, and we need it to inform policy, but actually we need good data, and we need, more importantly, good data analysis. So know thyself, and that's where I finish. So thank you very much for your patience. Thank you. There are a variety of resources that, if you want to do some further reading, with Stanford Encyclopedia of Philosophy, which is brilliant on so many different areas. So does anyone have any questions? Yeah.
I have two questions. One is, I just wanted, I didn't hear the surname of the guy who said that you can deduce where the crisis came from by looking at GDP. So you mentioned.
Oh yeah. That was Wynne Godley. W-Y-N-N-E, and then God, and then L-E-Y at the end. There's I think it's a New York Times article, and he was doing, I think it's called the flow of funds model, and it basically looks at high-level aggregates of financial flows in the economy, and it all works on the basis that if you have the private sector, the household sector, and the government sector, they all total to one in terms of expenditure. And so when you end up with a consistent level of expenditure, but then shifts occurring, then you end up with basically different expenditure being shifted to different groups in that economy, broadly.
If I
Yes.
can have the second question, I also
Yes.
wanted to ask whether there is a source, a data source that would have also quite detailed accounting of expenditure side of GDP internationally and nationally. Is it, because I understand the Blue Book is on the output side. I mean,
the Blue Book, the ONS has a variety of different measures that feature in there. So if you went onto the ONS website going via the Blue Book, it would direct you to a fair few things there. Internationally, I'm not sure offhand. It's one of those things where because we've got so used to seeing the figure just as a total figure, like this is the income of an economy, a lot of research going into the lower level, it seems to not be happening so much or in a widely published manner. So you'll find there are consultancies that will have models and will do various different projections and different breakdowns, but that's often used for their internal clients and not actually in a publicly available format. But yeah, if you have a look there, if you have a look as well at the, I think it's the European, they're called ESAs, European Standard Agreements, I think they are. Basically, the European Analysis Statistical Body has information for all of the different component countries of the EU, and they're using the same system of accounting, so you get some sort of comparability within there. But then that is always, of course, contingent on all the comments that I've made earlier about the fact that consumption is actually bespoke to countries. So I haven't checked their things, but they might have some sort of information there, hopefully.
Okay.
Yeah. Yep.
Do you think there are particular data that are used in economics that are more problematic in terms of measurement or politically than others? Which ones do you think that would be?
I don't know. I think that outright answer, I don't know. I think that the key thing is more that you should be stopping and thinking beforehand. So with something like, I gave the population example earlier, looking at the country, understanding the dynamics, understanding if there are groups within there that would get something from having extra people on the books. So you end up with, in some cases, false numbers of people on the books, or some countries thankfully this is reducing, this isn't so much so the case, but it's hard to know life expectancy of people because in some cases births aren't recorded. So that means when you go along, people will give you a random, they'll sort of say, oh, this is approximately my age, which means that could be very problematic. And I think one of my big issues at the moment with a lot of the income-based things is actually tax evasion and tax avoidance, which there's so much offshoring of funds that we simply don't know. There are a few Oxfam reports that maybe a little bit wide of the mark on some bits, but do give some estimates of actually the total amount of assets that don't feature on our books because of ways in which everything just happens off balance sheet, off the books. And so there's no way that the government would actually know, even in somewhere like the UK, actually what the total amount of assets or income is for certain organisations. So I think that I can't give you an outright avoid this one like the plague, but I think that it's more that you should be stopping and thinking before going and using a data set. Yeah.
Might these problems of measurement that they surface in current research, might this also be a result of how the economics profession, so the academic profession works? Because I mean, going really down into these problems, this is very tedious and it might be really frustrating. And so it uses up so much time and effort, and you can produce so much more research with not doing this. And this might be way better for you, especially if you have to score highly on these rankings on publications, which I think is not sensible. Do you think there's a connection?
There possibly is at that end too. My focus with this has been mainly more at the undergraduate and the teaching side because the reality is, and you can see it in the curriculum, you just don't get that much time to do these types of things, and compared with the past where you would do. What some people I know with terms like empirical economics, actually using what you've learned. I think that with peer review, that should hopefully catch out a lot of the dodgy material, and yet it was, as we know from things you can read online, there are many examples where bad articles get published and then a couple of years later people that can the data will find actually it's not that good. So I think you're right, there are some demand pressures kicking in as well as on the sort of supply side.
I mean, for this peer review to really work, that necessitates that people, or this information, for example, on Nigerian GDP figures needs to be widespread so that the peer reviewers can point to that and say, no, this is not working, you have to exclude that, you have to impute data or whatever. But if it's not, if it is not known because this is a systemic issue, then you end up having the same problems over and over. And well, this also leads me to think like how much prevalence really that original data gathering there actually is in economics. Because I'm doing economic history, and data might be scarce just because the sources did not survive. So this is a hotly debated topic. Then we have all kinds of problematic and biased data there as well. But it's well now increasingly discussed, and I just have the feeling, well, I did economics before, that it's not that much. Not widely discussed in economics because you have, especially for modern periods, you have an abundance of data. I mean, you can go to the IMF, go to the World Bank and download all kinds of data sets. So because you do not have the scarcity, maybe the importance of this data then is a bit diminished. I don't know. So this leads me to think like how much confrontation with the original problems of this data gathering is actually happening in economics.
Oh no, I think that there's definitely a technical change. I mean, if you have a look at the early period, the 1930s, and again, it also applies with econometrics too, where if you were going to go do some sort of analysis, you do your work, you prepare it, you'd submit it to computers in some cases, people would actually calculate for you, which meant that you do very much more restricted and much easier statistical processes. Then you got to the stage where you'd have computers where you'd put stuff in, plug it in overnight, and then you get your results back, which would inevitably be wrong. So you then have to then try and unpick the model to then try and work out what's going on, rewrite it, then submit it again. So just that iterative process could take days. So the cost to a researcher is going through the roof. But actually now it's at the case where, like you say, you just go along, get your data series, click a button, you've got it. And that doesn't necessarily give you that space to stop and think beforehand. Whereas, like you say, with some of the older data series, you really need to do a lot of more conceptual work. And in some cases they're created retrospectively, like you're saying, which I find I never really know which of the ones that actually they have created or not. But yeah, but it does. What I hope I've done with this is raise skepticism, and I think that's the most important thing when approaching any data. There comes a point where you have to drop it and then get on with actually producing the figures, but until the point where you're actually doing that, you really need to be rigorous with them. So, yeah. Seems to be it, and there seems to be a class outside. So, thank you very much for turning up to a talk about measurement, economic knowledge, accounting, and a whole host of things you normally wouldn't do at a lunchtime. Thank you very much.